Private life insurance companies finished FY22 on a positive note, even as business in the first half of the year was dented by the second wave of pandemic and a surge in death claims. Revival in growth and expansion in margins underline the performance of listed private players in FY22. With the changing product mix, leading private life insurers have seen an acceleration in profitability metrics such as growth in new business, improvement in new business margins, lower expenses, and better persistency. Going forward, life insurers will be impacted by moderation in growth and rising interest rates. Growth trends in the industry are distorted due to the COVID impact. If you look at the recent period, the annualized premium equivalent APE, which is a measure of ascertaining business sales in the life insurance sector, has moderated mainly due to muted growth in individual protection business. Price hikes and tightened underwriting have led to weakness in retail protection business. For instance, HDFC Life saw 4% decline in individual protection APE in FY22. And on the other hand, SBI Life posted 24% YOY growth in retail protection business in FY22 as price hikes were not that significant. The group protection business was strong, offsetting the muted growth in retail business. There was good traction in annuity business and non-par savings products remained in demand in FY22, fueled by low interest rate regime and competitive IRRs offered on these products. Having said that, the long-term structural growth story of the sector remains intact. Protection and retirement solutions are multi-decade opportunities and they will continue to grow faster than other segments. India has a protection deficit of 92% as per estimates by Swiss Re, implying that for every $100 needed for protection, only 8% is being spent by a typical Indian household, leaving a massive mortality protection gap. Now, this represents a huge opportunity. Life insurers have increased their focus on the protection segment, which is a key theme for the life insurance sector. And as the share of protection products continues to increase, there exists scope for further margin expansion. So given the promising sector outlook, which life insurance company stock is a worthy investment consideration at the current juncture? HDFC Life enjoys the most balanced product mix and has gained market share in the past 4 years through product innovation. Its VNB margins and ROEV are the highest in the sector. In FY22, its ROEV got impacted by excess mortality reserve, without which ROEV would have been 19%. Merger with Exide Life will get effected in second half of FY23, but it won't impact margins as per the management. Also, after the HDFC and HDFC Bank merger, HDFC Life will become a subsidiary of HDFC Bank, which will be an added impetus for growth through the bancassurance channel. Given these positives, HDFC Life trades at a premium to other players. Though the premium has come down in recent times, significant upside in near term is capped due to rich valuation, but it's definitely a long-term compounder. SBI Life has by far the largest addressable bancassurance network, consisting of more than 20,000 branches of its parent bank, SBI. Bancassurance has helped SBI Life grow much higher than peers over the last few years. Apart from being huge, this channel is under-leveraged, indicating a strong growth potential for SBI Life if the cross-sell efficiency of the bank improves. Again, despite being the bancassurance leader, SBI Life never defocused its individual agency network. It has a large network of agents and CIFs. Hence, despite its large bank network, its agency channel constituted 18% of new business premium in FY22. SBI Life has the lowest cost structure compared to peers, which is a substantial edge, especially in the current time when there are significant challenges to business growth. Given these positives and a reasonable valuation, SBI Life is definitely worth considering. ICICI Prudential saw good business growth in FY22, but we are more enthused by the business transformation, which is reflected in improving product mix, higher margins, enhanced distribution channel, and strong growth guidance. It's on track to transition from a capital market player into a diversified franchise by growing protection and annuity business, moving into new products and customer segments, enhancing the distribution capabilities and increasing granularity in its traditional savings business. ROEV, which was impacted by mortality variance in FY22, is set to improve. ICICI Prudential is currently trading at 2.3 times price to EV for FY22, which is reasonable given the growth levers. Overall, ICICI Prudential offers the best risk reward and can be added at the current market price. SBI Life can also be added on dips.